Okay folks, essentials to market structure. And this module is going to be really based upon the premise of looking towards helping you educate yourself in determining trade direction. This is probably one of the most reoccurring email inquiries and posts that you see in the forums on baby pips directed to me. Um, it's my goal obviously to share further amplification on some of the concepts that I use in determining trade direction, and hopefully this will be insightful for you. But what do we do when we sit down in front of the charts? What's the primary function as a trader? Well, you as a Forex trader, you want to be finding your way through price. And as a new trader, I can understand how daunting this task may be because there's so many different time frames. You have your monthly, weekly, daily, 4 hour, 1 hour, 15-minute chart, 5-minute chart, 1-minute chart. You have tick charts. All these different time frames. It's very bewildering sometimes if you don't understand really what it is that you need to be doing and breaking down price in a uniform, structured way. So the first thing I'm going to really counsel you on is your primary objective is to know your time frame that you're trading. Okay, and it gets back to what type of trader are you going to be? Are you going to be a position trader? Are you going to be a swing trader, a short-term trader? Or are you going to be a day trader or a scalper? I can't teach you how to find the correct style of trader. That's within you. That's all part of your personal makeup. So this module, much in the same capacity my other modules have been, they're going to speak in general terms, okay, but it's going to give you enough insight for you to be able to determine what it is that you need to be focusing on for you to find the most optimal way of trading for you yourself, okay, because each of us are going to be different. As you grow and you mature as a trader, you may be multi-time frame based in terms of trading. In other words, I consider myself a dynamic trader simply because I can trade any one of these time frames. Now, I excel in the short term to swing trading area, but I can day trade and I can scalp, but I prefer not to. It would be my advice to you is, if you can, try to work within the short term to day trading in the beginning, because it's going to give you the most immediate feedback and it's going to give you the confidence you need to be sticking to a plan, because obviously as a position trader you don't have a whole lot of opportunities materializing that frequently. Swing trading, again, same capacity. It's going to be a little while between each setup, so it's going to be harder for a new trader looking to find themselves to wait between the signals and stick within that specific framework for trading. So short-term trading and day trading and scalping, let's just avoid that for now, but we will talk about how you can utilize these concepts for scalping. But again, short-term and day trades, if you are brand new to price action, those are very rewarding because they give you the immediate feedback new traders sometimes need. So let's talk about what the professional perspective is when we're applying market structure. Well, obviously for position trades, this is going to be anywhere between 3 to as much as 6 months to a year in terms of duration. Now, I don't have a whole lot of types of trades like this, but every 3 to 4 months in the marketplace, whether it be in stocks or commodities or Forex, there is a specific swing that manifests itself, and we talked about that in other videos and other teaching. I'm not going to cover that here, but if you are that type of trader, obviously the 3 time frames that you would utilize to break down market structure for your particular market would obviously be monthly, the weekly, and the daily. Okay, monthly being your highest time frame, your weekly being your midline or mid-level time frame, and then you have your daily. That would be your short term. Now, as a swing trader, okay, your premise for breaking down market structure will be comprised of looking at the daily, the 4-hour, and the 1-hour chart. Okay, your setup will be based upon what you see on the higher time frame, the daily. Much in the same capacity for a position trade, the monthly will be your position trade premise. In other words, if we are considerably overbought, there should be some kind of a topping formation on a monthly chart. You would look to see market structure break down on the weekly and daily to facilitate a short position. Well, on a swing trade model, you would utilize that same measure of market structure by utilizing the highest time frame for swing trades. In this approach would be the daily chart, and then breaking that down into 4-hour chart, and then lesser price action study in the 1-hour chart. So you'll be timing on the 1-hour, you would be managing on the 4-hour, and the premise or the trade idea would be built upon the highest time frame, which would be the daily chart. Okay, in the swing traders model here. If you're a short-term trader, obviously the duration of time for these types of trades could be anywhere between 1 day to as much as a week or so. Swing trading is about a week or more in terms of trade duration. I forgot to mention that. But for short-term trades, you'll be using the 4-hour chart for your trade premise or your directional bias. And then on the 1-hour chart, that would be your trade management or mid-level time frame. And then your 15-minute chart would be utilized for your timing for entry and possibly looking for early reversal signs that your trade may be petering out and it's time to take profits. For day trades, obviously, you can see it's the 1-hour chart. It'd be your highest time frame. You would be managing your trade on the 15-minute time frame, and your 5-minute chart would be utilized to enter. Now, it's not to say that you can't use a 5-minute chart on the short-term swing and position trades for entry. Okay, I'm giving you the framework for at least having 3 time frames across the spectrum of your trading, and how you break down market structure over these 3 specific time frames for each individual trading model will give you, again, the building blocks to flesh out what you need to see in terms of directional bias. Okay, so let's take a look at closer look at price action and market structure. Now, the keys to multiple time frame market structure, okay, are rather simple. Where's your focus? Your focus should be on the highest of the 3 time frames. Trades will be managed by the highest or mid time frames. Okay, in other words, if you are a swing trader, you're going to be utilizing that daily time frame to manage, or the 4-hour chart to manage your trade. Okay, but the daily is going to be utilized to facilitate the trade premise. In other words, that's going to give you your directional bias. Okay, the market structure that is on the daily chart, that's framing your swing trades. Okay, once you get into a trade, you would be managing that trade on a 4-hour time frame, and you would just use the respective time frames we just talked about in the previous slide. And then your 1-hour chart would be used for timing purposes. Okay, so the shortest time frame in that regard for swing trading would be the 60-minute chart. So your entry signals would be derived from having studied the market structure on the daily and the 4-hour. Then your 1-hour chart would facilitate the specific entry point. Okay, so in other words, you would do your entry concepts and techniques on the 1-hour chart for swing trades. The highest probability trades are made in the higher time frame direction. Okay, now there are going to be instances where the higher time frame premise may be bullish, but you're approaching a key resistance level, so that may be trumped. So that's where we're going to go back to the core essentials to technical analysis, that being support and resistance trumps everything. Okay, without the understanding of key support and resistance levels, you're not going to get to a directional bias regardless of what trading model you're using, position, day trading, whatever it is. If it's not framed on the premise of key support and resistance levels, it's probably going to be a struggling point for you as well. Okay, so you have to go back to the core essentials, to my concepts, and just sound trading altogether. Key support and resistance levels are where it's all at. Okay, without those, all of these lines and all of these procedures that we're going to be covering here and what we've covered in previous videos and such is going to do no good to you. Okay, so you have to understand what is a key support and resistance level. So if you are looking at the highest time frame for your particular model, that will hopefully draw your attention to whatever key support and resistance level at that point in price action. Obviously, you can always go out to a daily and weekly just as a a catch-all as far as whatever time frame you're trading. If you just look at a daily and weekly in terms of support and resistance, those will be helpful to you. Now, the market profiles will also assist you in market structure analysis concepts. That being, are we in a trending market? Are we in a reversal pattern or formation, or that type of profile in the marketplace? And are we in a consolidation, preparing for a breakout scenario? Okay, so market profiling is essential to helping you and assisting you in measuring what the current market structure is. Okay, now, are we bullish or bearish? All right, when we're looking at market structure, or we're referring to market structure, what are we speaking about? What is the that we're trying to get at? Okay. Well, if you look at a price rally up and then price hitting a major resistance level, we're going to assume for a moment that this is your higher time frame. Okay, and I'm going to keep it generic because that way you can apply it to whatever your higher time frame is based on the model of trader that you are aiming to be. As price rallies up into what we would perceive as a higher level key resistance level, price never moves in a straight line. Okay, so there's going to be a consolidation, a price move up, another consolidation, a price move up, and then as price makes it into this resistance level, then we would be anticipating a reversal. So when markets start to break down, taking out short-term swing lows in here, this short-term swing low, when the highest time frame for your particular trading model, once that breaks, this would be the catalyst for you to say, okay, this is probably going to be an optimal trade entry based on the higher time frame chart of your profile. Okay, so for an example, let's just say that this is a monthly chart and you're looking for a position trade. Okay, if the monthly hits a key resistance level like this and it comes down and takes out a short-term low in the monthly, we know now that market structure has broken. Okay, so we have a market structure shift right here. Okay, now we don't know what price is doing over here. This is all in the future. We're anticipating these types of events in terms of price action, but until it actually gets there and starts trading, we can't deal with that yet. So it's all in anticipation in our anticipatory model as far as our framework and thinking about price action. This is what we would expect to see once this structure has been broken. Okay, but as price starts to rally up, we don't anticipate seeing a break through this resistance level. Okay, if we arrive at this as a possible resistance level, we would expect a retracement for an optimal trade entry, but then we would zoom in this area right here, okay, on a weekly time frame to hone in on more key shorter term time frame price levels. And then by zooming in, okay, we would possibly see a shorter term optimal trade entry or respective sell pattern to convince us even further that this is probably going to be a selling scenario. And if we move down into a daily and see something even similar to that, okay, you would have all these nesting confluences of implied resistance levels. Once a higher time frame market structure is broken down, then we would be able to position ourselves in sync with a top-down approach with market structure. Okay, and then as price starts to trade down, this is the gray area. All these areas where there's missing gaps, okay, that's intentional. Okay, we don't know what's going to take place between the time where we see an entry point and where we expect to see price get to in terms of our targets, and we'll talk more about that later on. But this is the gray area where you have to be comfortable with, okay, because you don't know what's going to happen from where your entry point and your expected exit point. Okay, you don't know if it's going to go down there. Okay, you don't know if it's going to reverse and take you out of the trade. Okay, but the overall framework, okay, or price structure, okay, this is how market structure is built. Okay, this is a price rally and a decline. Okay, we have consolidation. If we expect to see some kind of a rally in here, something's bullish that we would expect to support at, As price starts to rally up, okay, we could be utilizing our mid-level or shorter term level time frames to see bullishness. Okay, we want to see support being held, resistance being broken. Okay, and every time price starts to pull back and retrace in here, the market structure concept that you would be utilizing would be to simply look for optimal trade entries. Okay, for buys, you would be looking for reflections to buy. You would be looking for type 2 trend following bullish scenarios. So in other words, in all this area here, you'd be looking for price finding support and resistance being broken. Okay, it's that simple. That's the whole framework behind market structure. And as price rallies up into another shorter term or intermediate term resistance level in here, price will hopefully find some support. Okay, but if it does start to break down, be comfortable with price coming back and blowing out previous lows in here. Okay, there may be an important low that's taken place, and trailing stop loss orders would be trailed up below that particular point. Okay, so as price dips back down, all that's going to do is give you another opportunity to get long. Okay, now again, let's think for a moment. This is the higher time frame premise. Okay, this is the highest time frame chart. When we start seeing this consolidation in here and we see the higher level resistance level, because these are all known in advance, this is why we have support and resistance studies done. This is all part of our top-down analysis, seeing where price may be reaching for. So if we start seeing price rally up in here and then consolidate again, and this is another higher level key resistance level, if price continues to maintain support and breaks above all of these short-term highs in here, the market structure implies that we could possibly see a leg from this low, or whatever low would form back here, to this high, duplicated on the retracement here from this low to this high. The same thing could be said with market declines and reversals going along. Every time we see a consolidations, you want to study these for shorter term, more dynamic support and resistance levels. These areas are more easily tradable because they have discernible price levels. They're very clear. We don't know how it's going to take price from these consolidations to the next consolidation. We don't know that. We anticipate that gray area that's missing, these little pieces of market structure that's missing. I left that out because I want you to think like this. Okay, if it's a little confusing now, I understand, but if you apply this same general, I don't want to say profile, but this diagram, okay, in other words, in terms of how I have price lows illustrated here, if you look at how price declines actually materialize, you'll start to see these lows form like this. And inside of those consolidations and every swing low that forms, there's going to be a discernible optimal trade entries or reflection patterns, or generally fractal patterns. Okay, so you would apply these concepts, okay, with all the other concepts we've previously discussed, but looking at obviously a higher level key support level down here as a catalyst. Okay, so as price moves from a consolidation down into a new consolidation, much in the same capacity we just saw with the bullish move reaching up into a higher level resistance level, we could be seeing a consolidation in here with this higher level support level down here. This would be where price may be reaching for. So if it's consolidating here, we could look for a move from whatever high forms here to this low, okay, duplicated from this high or whatever high forms in this area down to this low. Okay, so while this diagram is fragmented, okay, think of in terms of the market maker profiles that I just recently shared with you guys this year. You see that same premise here as well. I don't need to draw the lines in here. You can actually probably remember by the way the profile was given to you. You can actually see it in here. Okay, so as price is engineered to go lower down into a support level, ultimately to trade higher, this is the building blocks that we work with. Okay, now because we have to live in the gray area and not expect a simple black and white premise to trading. When we see a consolidation here and price move down to a new area consolidation and price moves down to a new area consolidation, and then we have short-term breaks on market structure. Okay, in other words, we have a shift in market structure right here. As price trades down to that support level, again, this is all assuming this is the highest level of your 3 time frames that you're trading with for your particular trading model. When you see this shift in market structure here, we would anticipate seeing a bullish move higher. But here's where we enter a new level of gray. When we move into this new consolidation in here, this may not always translate into even higher prices going up like we have here implied. It could be just reaching up to go back to this range from this old high to this low. Remember, inside the range concepts. Okay, so you have to have that in mind. So that's why if you're going to be getting long down here, you expect to see some kind of profit taking here. Right, and you would be able to see that utilizing your mid-level chart, okay, for your swing projections. Okay, and we'll talk about that more as we go on. But generally, as you see price come down in here, every time price retraces and gives you new optimal trade entries, that's what you're looking for. You want to see price holding support, breaking resistance, okay, on this side of the support level being found. But as we're trading down into that support level, we're anticipating market structure to break lows and then find resistance. Break lows, find resistance. Break lows, find resistance. Okay, so every new consolidation, if we're expecting price reaching down to our higher level support level, okay, on our highest level chart, that's why we do our analysis on the highest level, because you want to see where price is probably reaching for. And by seeing where the highest level chart in our particular trading model is reaching for, again, we don't know for certain that they're always going to get there. But if you look in these higher level charts, it's going to give you the highest probability in terms of success. If price doesn't get to these particular points and we start seeing early market shifts in market structure, this could be a catalyst for, another type of trade. Okay, we could possibly get a long in here and maybe even reach up into the range from the high to this low here. That may be a means of profitability. It could be a good reward to risk scenario here. Okay, 3-to-1 could still exist within that framework of price action. Okay, but again, even if that happens, we could still take some short-term trades in here, but that may be a very, very short-term bias, only taking you up to a higher level bias to get lower support levels here taken out. Okay, in other words, you're going to have to blend some concepts here. The inside the range concepts, simply looking at lower lows and lower highs. Okay, if we do get a short-term bounce in here between the high that's formed here and the low here, this could be creating another optimal trade entry to get that fulfillment of this lower level support level down here. Now, again, we've seen this diagram before. Assuming that we have a high up in here reaching into resistance. As price breaks this short-term low here, the market structure is broken. So as price starts to retrace, every time it retraces, we're looking for new selling opportunities. But if we see a previous swing, as we see here, see this price swing here? Okay? If this level's taken out here, if we get a retracement or another additional sell signal, this is where we use swing projections just on price. We're not using Fibonacci. You can, but just looking at simple price action alone, this low to high, once it's broken, you can start taking this same measurable swing from this point here down to that same level and project it lower. Okay, and you get somewhere in this area here. Now, I purposely allowed the diagram to be a little bit farther because I teach to exit on the trade before the actual objective is met. Okay, so every time we see a broken swing, okay, this is a swing that's broken here. In other words, this low here, or whatever low it would have formed in here, I'm assuming that you can see this as a swing. when it's broken right here, we went below it here. If we retrace back into it, okay, I also purposely drew this a little bit past what would be expected as resistance. I've purposely allowed this to move beyond this low here to illustrate how support and resistance can be gray as well. It's not black and white. You're going to have to allow some flexibility with price. So when it starts to pull back deeper, okay, this still could set up the optimal trade entry. Okay, and while this isn't the exact level price was able to stave off a rally, it still was working within the previous range here and this high here as well. So we're still within a bearish market structure. So don't be lulled into thinking this is going to be a long to go higher, assuming again this is a higher level resistance level. And again, every little short-term retracement in here could be a catalyst for an additional entry using our smallest of the 3 time frames. Again, this is all modeling off of the highest time frame, okay, and then assuming once we get this broken down, this swing low here broken, we could utilize the mid-level chart for additional entries and or managing of a position that's already been assumed based on the highest of the 3 time frames. Now, as price also breaks down these swings, in other words, this swing up, once it's broken, okay, this is an engineered swing, okay. You see this in price action all the time, okay. It's a measured move. It's very simple. Taking this low to this high, whatever that range is, subtract it from that same point here and project it lower, okay. That's the measured swing. Here is a measured leg move. You have the high down to a low here. And when price starts retracing here, we could see this as an intermediate term price swing, okay, or price leg. So we have a measurable swing here that we can use for projections. Then we also have a measurable leg. Okay, so we have the first leg of price down here, and we retrace back utilizing the framework that's based on this swing up. Okay, so we're blending 2 concepts here. A swing that's broken, okay, and within a bearish market structure. Then we also have a retracement back into a previous support. Broken, it should act as resistance, okay. And notice how this low here, I try to more or less imply that price could be reaching for even a shorter term support that's broken now as resistance. So what might look real clear and discernible on the charts, it may not be as clear cut as that. But we would expect this to be an intermediate term retracement for a new leg down. And that's when you would expect to see the high to low here on this leg repeated and projected from this high, whatever forms here, down here. And that would look similar to what we'd expect when you see intermediate term highs and lows. Intermediate term high is obviously a high that has lower highs on either side of it, okay, and an intermediate term low is a low that has 2 higher lows on either side of it. So it's very easy to see. It's simply looking at your candles and your bars on your respective time frames, and when you see these, note them, okay, and by noting them you'll have whatever ways you want to have it. I'm delineating and denoting that with these blue circles here. It could be anything on your charts. You could have stars. You could just type intermediate term high, whatever. You could put the little arrows on it. Whatever it is that you use to identify them, that's your way of doing it. But it's important you understand where they're at. And when they start to nest out like this, okay, you can classify intermediate term to now long term, because if we have lower highs on either side of it, okay, this would classify this as a long-term high. That would also allow you to expect to see much longer term price swings, okay. So by nesting out and marking off your swing highs and swing lows on your respective time frames, you start to build the framework that's needed to be able to discern if you're in an intermediate term or short-term price swing and within your market structure. Now that leg that we were talking about earlier can be seen here by having that intermediate term high noted. So this is a intermediate term price leg, and then here's your intermediate term retracement, okay, and then you would see obviously the next leg down would be replicated. So you can see the range between this low to high is exactly what you see here, causing you to expect or anticipate price movement back here. If you're in the trade still, once you retraced, you can expect to hold on to that trade to get back down to these levels here, which would obviously hopefully be a higher level support level to also converge and have a confluence of reasons to expect to take some profits there. Now, by having all these things in the forefront of your mind and having specific price legs and price swings and how they nest together, it's important you understand that the framework of your market structure is derived from the highest level of the three time frames you're trading with. That's where the framework or the basis of your trade is built upon. Your mid-level chart is used to zero down into a smaller time frame expecting to find support and resistance levels that may not be discernible in your highest time frame. Then your lowest time frame is used for your entry, and we're going to talk about that specifically here. Assuming that we've built the premise of market structure and assuming that it's bullish, okay, everything we're talking about here would be obviously reversed for selling scenarios. But assuming we have a bullish market structure, okay, we're a swing trader. Let's say for a moment that our highest time frames suggest that we have a bullish market structure underway. We've traded off of a higher level support level, and price has given us a broken market structure to the upside. Okay, so there's been a market structure shift. Short-term highs have been broken on our highest level time frame chart. Our mid-level time frame has allowed us to zero in and find a key support and resistance level. Now we have this higher level key support and resistance level that's also converging with our mid-level support and resistance level. Okay, and that same support and resistance level may be a confluence of maybe a pivot, a trinity level. Okay, it could be a pattern that overlaps with that specific that level. Okay, and we now have a bias. Okay, this bias is bullish. It does not mean every single day you're going to get a trade that's going to materialize as a bullish move and see profitability. If it was just that simple, guys, everybody would be multimillionaires and be we'd all be Warren Buffett's and super rich. So obviously, it's not that easy. You have to have some discernment and allow for some failure, because it's going to happen. But assuming that we have that premise, okay, our bias is to buy. It doesn't mean that traders can't make money going short this specific day or time frame. Okay, it just means that you are going to stick to being a bull at this particular day or particular time frame. Okay, so with that in mind, we always go back to our key premise of trading within kill zones. Okay, so you want to be doing your entries in your kill zone times: London Open, New York Open, London Close, or Asia. Okay, but assuming we have already arrived at our time of day when we're going to be trading. Okay, we already understand that the kill zone, when it's going to begin. We already have our key support and resistance level already identified, and we know where price should get to before we do anything, and that's going to be basically this little area right here. So when we're going to be seeing price hopefully at some point move down to that level here, this is our action point. This is where we take action. We do the entry here, and it could be on a limit basis or it could be a market order, but we're utilizing time and price theory. Okay, so this is what it looks like in your mind. There's nothing happening yet. You anticipate these events unfolding within a specific time of day with a specific bias in mind. Okay, you want to see these things line up. And I think what happens is you guys send me emails, you talk about it on the internet, posting on Baby Pips forums. I don't know what the bias is for today. Here's the secret. Every day the bias is both directions. Every day the bias is both directions. Think about that. There's traders making money going long and short that day. But you have to decide on what it is that you're trading based on your time frame and your profile. Okay, as a trader, are you a short-term trader, swing trader, are you a position trader? And you're looking for the bias that you're holding to line up with price action. Okay? You can't force price action to do what you want it to do. You can only get yourself in sync with what price may be doing and allowing you a ride. Okay, so with that assumption, we're looking at price here with the bullish premise that we would be expecting to see higher prices if we get down to this support level. Okay, so we've established that the higher time frame of the 3 time frames we use for market structure study is now bullish. Okay, we assumed that we have a very respectable support level down here. Okay, so if price trades back down to that level within a kill zone, we're going to be taking action here to buy. Okay, and all we simply do at that point is you wait. You wait until the kill zone starts, and when price gets to that specific point, you use whatever entry technique or concept that you're going to be utilizing for your trade entry. It could be optimal trade entry, it could be reflection, it could be a grail, it could be a stinger, it could be any one of the trading patterns that you're utilizing, but it's happening at a key support resistance level with the higher time frame of the 3 time frames you use for market structure giving you your bias. So when you have that, this is your action plan. This is what you do. You don't do anything else. Okay, this could be a sell pattern here, okay, for someone that's a very short-term trader, okay, and trades down, and they've made money from this point here to here. That's not your trade. Okay, so don't try to force more out of the concept than it's intended. Okay, you're just simply looking for a bias for your style of trading. Okay, it doesn't mean that you're going to be right all the time. Okay, so take that out of the equation. All you're doing is looking to get yourself in sync with whatever price action is doing based on your premise or your style of trading. All right, obviously this is a very simple approach to dealing with directional bias, but it's meant to help you avoid the overcomplication that tends to happen with traders. Okay, and it's usually the new traders that try to add all these things to it and squeeze all the tools into, giving them a directional bias with the expectation, falsely albeit, that they're going to always know what direction the market's going to move every single day. And I'm going to tell you guys, I've been doing this almost 20 years, and I don't get it right every single day. Okay, you know what the secret is to my trading? I simply wait until everything lines up that I like to see, where the majority of all my tools, not all of them, the majority of the things that I like to see based on my understanding what markets suggesting to me. In other words, or what profile are we in? Are we overall ripe for a reversal? Are we in a trending condition? Are we in a consolidation area where, I don't want to be taking any kind of trading, with the expectation that we're going to have a trending type of event unfold, because we're going to be working within a large consolidation. I use that as my building blocks, and then by using the market profiling to give me the initial clue as to where we may be trading, then I start looking at actual individual market structure concepts on the 3 time frames that I use for whatever type of trading I'm doing at the time. Because I am dynamic, I move from one time frame or profile trading to another. One week I may be simply a day trader. In other weeks I'll be a short-term trader. And I wish there was a way for me to teach that premise from moving from one dynamic to another. I can't. So it may be disappointing to you, but this is a limitation on me as a mentor. I don't know how to communicate that. But I can give you concepts and approaches to do specific styles of trading, and you just have to wait for the opportunities where price action gives you that sweet spot in terms of being able to apply it. Okay, so by selecting a directional bias, this does not guarantee profitability. It's very important you understand that. Nor does it guarantee accuracy in either your trade direction and or your trade results. One trader's bias may be bullish. Okay, they're looking for buys, and that may exist inside the realm of another trader's sell bias. They both can be correct and make money, and even see both their respective profit objectives achieved. They both can be wrong and make money despite their respective profit objectives not being achieved. Again, it's not being about being quote unquote correct. It's about being profitable. However, they both could simply lose money and neither trade idea come to fruition. There is no black and white. It's very important you understand that. As a trader, you must enter the gray and be comfortable with the less than perfect visibility. Trades with the the foresight that you're expecting don't exist. Nobody has a crystal ball. I don't have it. I'm still trading on the probabilities, not the perfect scenario. There's no perfect scenario, okay? You, as a trader, will see trades materialize that will provide you plenty of profit-taking potential. Live there. Don't expect 100%. It's not going to happen, okay? Because I guarantee you, the only thing 100% is going to happen is you're going to go nuts expecting an impossibility. Find your time frame as a trader. Determine the market structure given for that time frame. Trade within that respective market structure and perform your targeting on the highest and mid-level time frames. And I promise you, you'll have more than enough trades laid at your feet. But it's not about trading every day, and it's not about capturing 1,000 pips a month. Okay, it's about consistently harvesting profits out of the marketplace, keeping risk low, and your action level low. Don't try to trade a whole lot. Keep your trading controlled. That way you're going to control your emotions, your expectations will be kept realistic, and you're going to live comfortably in the gray.